Welcome to Winning with Annalee. I'm so glad to have you join us today, and I am so excited about my guest today, Bob Payne. Good morning, Bob.
Good morning, Annalee.
How are ya?
Well, the pleasure to be here, and it's a lot warmer than where I came from.
It is. Let's see, you flew here from
Philadelphia.
Philadelphia.
Yes.
Just a degree or two warmer, I would say.
40.
40 degrees warmer. I love it. Bob Payne is the Chief Investment Officer of Payne Capital Management. And Bob and his company, Payne Capital Management and Mainstay Financial Group, we formed a partnership several years ago because we found out we have one constant recurring theme when we work with people, and that is
Helping them achieve goals and education, right?
Education, helping them achieve goals, because how do we get them to a goal? We educate them. If I can educate you, I can enlighten you. If I can enlighten you, I can empower you to make the right decision. And most of the money managers that you work with just don't seem to have that philosophy. And Bob and I talked, we decided, yep, we work the same way. Bob has a tremendous history in the securities field. I mean, my gosh, you worked with several of the large firms.
That's true. The biggest was my long tenure at Merrill Lynch.
At Merrill Lynch. And then you basically made the decision, after training everybody and teaching everybody, made the decision to start your own firm, which I'm glad you did.
Well, it was not just my decision, but my, it's a family business that we run. Mm-hmm. And my partner is my son, Ryan. Yes. And he decided it was time to go out and be more entrepreneurial and start our own firm. So the day we left Merrill Lynch to start Payne Capital, 2 weeks later they went under.
Yeah.
Now, according to my son, that's the reason they went under.
Of course, because you left.
I
agree.
I'm not going to disabuse them of that notion. I think they had a few problems with the subprime mortgage industry, but they're living successfully with Bank of America, and we're having a great time at Payne Capital.
We are having a great time. One of the things I'd like to talk about today, Bob, if we could, a lot of people are afraid of the market, and rightfully so, because many people have been burned very badly, lost an awfully lot of money. People that thought they could retire, all of a sudden they couldn't. People working more years than they thought they would have to work. And in my personal opinion, that never should have happened to those people had they been invested correctly. I don't think those things would have occurred. So we find a lot of people sitting out there, and they'll have money in what they call that little safe bucket, which is either the bank or the money market, where they're actually making nothing. And you and I have talked about this several times. I mean, I don't have a crystal ball. Did you bring yours?
Mine shattered when I got out of high school.
I can't tell the future, but I really think that little creature that we call inflation is going to constantly keep doing what it has always done. And it's kind of like the phoenix, it rises from the ashes when you think it's not there. And you got a great example of that I think everybody can remember.
Well, I think that's the key. I mean, the reason people have to invest is you have to keep up with the cost of living.
Yes.
The cost of living is going up our entire lives. And it's that insidious hidden tax. Mm-hmm. So if you sit and do nothing, if you sit with that remember the old passbook accounts we all had as kids?
Yeah.
It was so nice to see that value go up and never went down. I think that's really kind of a curse, because if you have that attitude that I don't want to see volatility, I don't want to see my money go down, mm-hmm. What you don't really see is that you're guaranteed to lose money because of inflation. And inflation historically runs about 3%, the cost of living. But right now it's only about 2%. So it's been a little bit under control, but nonetheless it's there. And if you sit in cash, you're losing 2% a year. Guaranteed. Yeah. It's the only guarantee I'll ever give anybody. And that's a guaranteed loss. But, we put together a little slide for our audience today. And we went back and we looked at the cost of a quart of milk back in 1913. And for 6 cents, you could buy a quart of milk.
Wait a minute. 6 cents I could buy a quart of milk.
A quart of milk in 1913.
Wow.
All right, so now what hasn't changed is milk still comes from cows, at least milk that we usually think of. Now there's so many different types now. But and we still use the same currency, the U.S. dollar. But right now, 9 cents would only buy you a small cup of milk, and that was in 1963 when I was 10 years old. So from 1913, my grandparents could buy a quart for 6 cents. When I'm 10 years old in 1963, I can only get a small glass. Now let's talk about today. That same 6 cents will buy you 6 teaspoons of milk.
So wait a minute, we're talking about the same 9 cents.
Yep. Oh, 9 cents. I'm sorry. Yep.
A quart to a small glass to 6 teaspoons. That's inflation.
That's inflation.
That's inflation.
And you can apply that metric to just about anything. Remember when it cost the stamps were 3 cents, 4 cents?
Sure.
I don't even know what they are now because we have a forever stamp.
Yeah.
But I think it's like 49 cents.
Yeah.
You look at the cost of everything, and the cost of everything goes up. I mean, you were talking earlier about a lot of times you'll, in your instructions to people, you'll talk about the cost of their first home.
Yes, and we do that in the classes, and I tell everybody, write down, and you can do this right now, write down what did you pay for your first home, your very first home, what did you pay for it? Right on top of it, write down what you paid for your last car. Now, those of us who have any years behind us, I can tell you the last 5 cars I've driven cost me more than my first house. So it's kind of like I get into my car and I'm looking for where's the bathroom, where's the fireplace, I should have a bedroom in here, because I bought a doggone house. And we just don't think about it that way because it creeps on you. It truly, truly does. So, okay, Bob, so people say to me, well, Annalee, I understand that, but investing is risky.
It's true. Investing takes risks. And because risk is price change, and that's called volatility. Everything changes in price. Everything changes in price every second of the day. The home you're sitting in right now is up or down in value versus where it was this morning. Your stocks, your bonds, everything changes in price. So, yes, there is risk, but there is the risk of volatility. But that volatility is necessary to give you an above-average return to overcome inflation. And it's that cost of living increase that people have to overcome in order to invest successfully. Now, doing nothing is also risky.
That's risky, too.
And doing nothing is a decision.
Sure.
All right? So you have to make a decision about what you want in life, and that's where I think planning comes into play. You have to have a plan. You have to have a goal in mind, and you work backwards from that goal to establish your investment process. And we call that the A to B investment process. Getting from point A, where you are now,
where I am,
what do you have in investments? What do you have saved? What are your passive income streams in your lifetime? What are you entitled to? What are your pensions, your Social Security benefit, any inheritance? Okay, and then you got to look at point B. And point B is, what do you want to accomplish?
Exactly.
Now, I don't know about you, Annalee, but last I checked, none of us get off of this mortal coil alive. All right, so we know one day we're done.
Right.
But between that point now and point B, what do we want to accomplish? All right? How much money do we want to give to charity? What do we need to live on? Can we create that lifetime of income that we can't outlive? We want to educate our children, our grandchildren, and our grandnieces and nephews.
And the grandnieces and nephews, yes.
For sure, right?
Yes, certainly.
So, we need to ascertain what those are, and then you work backwards to point A, and that's how you establish the proper investment strategy.
Yeah. And I think the other thing we have to do, Bob, and it's one of the things I teach in my classes, we've got to plan for the what-ifs. You talked about inheritance, and then there are those of us on the other side who you could lose half your family and go into debt because you're going to be the one paying the medical bills. You're going to be the one paying additional funeral costs. So you've got to plan for those what-ifs. What is going to happen, and which bucket do I take money from? And I talk about that in my classes. Again, because it's something people can remember, but I talk about 3 buckets of money, and it's one that's your emergency money, because we do have our storms, we do have the roof that has to be replaced, things happen. As I say, life happens. You could put it another way, but let's say life happens. Then you've got to have that money that's your income stream.
Yep.
You talked about that, your Social Security, if you're lucky enough to have a pension, maybe an annuity that's going to come in at some point and give you income. But then you've got to have that inflationary bucket. that takes care of the rising cost of things as they happen. And one of the mistakes I find people sometimes make is they've got that risk bucket, but they don't have the middle bucket. So if the market does drop, what do? They reach into the risk bucket, and what did they just do to their loss? They made it worse.
They sure did.
You know, so investing in the market is a time-driven thing, isn't it?
It sure is. It's time in the market, not timing the market. That's really an important point. It is. It's very different because we're all taught, that, or at least we watch, which I like to call the financial pornography channels. We look for them to give us advice, but they're not giving us advice. They're entertaining us. And, you're supposed to, buy an investment yesterday and trade out of it today. It's the most ridiculous thing I've ever heard in my life. Over time, you're rewarded for investing. Now, I know that because the history of the financial markets they've gone up over our entire lifetime. They've done it over our parents' lifetime, our great-grandparents' lifetime, since our ancestors arrived on these shores, since before they got here. All capital markets have gone up in value. So, but you don't know what they're going to do tomorrow.
No.
You don't know what they're going to do tomorrow. But the key is if you go back and you look at $1 invested in the stock market back in 1926, that same dollar is worth $4,600 today.
$1.
$1, okay? You take the same dollar and you put it in the bond market, and that same dollar is worth $1,100 today. But if you take that $1 and you put it into small company stocks, that's worth $17,000 today. Wow. That's what you need to do to overcome inflation. You don't need to speculate. You don't need to gamble. You need to become an investor.
So it's not being the fortune teller. It's taking and having a plan and sticking with that plan. And I think we're going to take a quick break, and when we come back, we'll talk a lot more about the importance of that plan.
Sounds good.
Okay.
Mainstay Financial Group offers advocacy and personal financial guidance in a caring environment. That's the heart of our practice. At Mainstay, we're dedicated to exemplary service and a caring relationship with our client, not with a number. Plan for the future now with Mainstay Financial Services.
When you're finished with your food or beverage cartons, toss it in the recycling bin. Because every carton is recyclable and can be turned into useful paper products. Put your carton in the bin with your other recyclables and let them start a new life. When the contents are gone, let the carton live on. Recycle your cartons.
So, I'm kind of new here, but I've noticed a trend. My human does this funny thing where she goes around and gets all my toys, and then she hides them in that basket by the door. It's like, hello, that's where you put it last time. You were the worst at hide and go seek.
I started mentoring my mentee, Dantre, 4 years ago. I always thought about doing it.
Etienne's a very close friend. I look at him as a brother and a father figure. I would like to give back, just like Etienne gave back to me. Be someone who matters to someone who matters.
Everybody needs a helping hand. Take a look at your fellow man and tell me what can I do? What can I do today?
Courtesy. Pass it on from the Foundation for a Better Life.
Welcome back to Winning with Annalee. I'm your host, Annalee Leonard, president and founder of Mainstay Financial Group on the corners of Antes and Perry. And I have with me today the Chief Investment Officer of Payne Capital Management, Mr. Bob. I'm so glad you're with me today. Bob and I work together with our clients. Bob and his wonderful crew that he has, they help me to stay in communication with our clients, make sure we have diversification, a right portfolio, and a plan. So, we're kind of talking about this idea of the market and its efficiency. Your company did a great experiment with people on guessing.
We did. We took a big jar of jelly beans, and before every seminar, we would put it in front of the room, and we'd ask the audience to guess how many jelly beans are in the jar.
Okay.
Now, here's the amazing thing. The low number was 409 jelly beans.
All right.
Okay, the high number was over 5,300.
Oh, my goodness.
Yes, and those people were really wrong.
Okay.
They were really wrong because the average, when we put in all the guesses together, was 1,653. So the 409 was real low, the 5,300 was real high. The actual number was 1,670. So almost, if you took the collective wisdom of our audiences, they come up with the right number. Individually, they're way off in a lot of their guesses.
Definitely way off. And don't you think that's what happens to people when they're trying to time the market on their own, or the individual person who thinks, I listen to all these guys on TV, I know how to do this?
Well, I think that's the big myth. The big myth is that investment prices are mispriced. So if you have a little more information than somebody else, you can outguess the other person and take advantage of that mispricing. But you could see from the jelly bean experiment that collectively we're all better together.
We do much better.
Much better than we do on our own. Just take the last year, Annalee. I mean, our bond portfolios did very well, in spite of the fact that the collective wisdom, or the conventional wisdom, I should say, of the markets this time last year was interest rates were going to go up. Right?
Yes.
Didn't everybody tell you that rates were going to go up?
Yep.
That meant bonds would go down. We had a phenomenal year in our bond portfolio because the conventional wisdom was wrong. It's really hard to predict the unpredictable and know the unknowable. As a matter of fact, I don't know anybody that can.
I don't either. I've looked for them, to tell you the truth, but I have no idea. And just to keep up as an individual, I think, with what goes on in the market on a daily basis, I don't know about you, but most of my clients like to go out and live their lives and spend time with the grandkids and travel, and I don't think they have the time to sit there with the market.
No, they really don't, and it's there's a lot more to life than studying a prospectus or a 10K or a 10Q, but the markets are very efficient. Believe it or not, there's 42 million equity transactions that occur a day.
A day.
Yeah. Now, remember, the stock market and the bond market are auctions. All right, there's a buyer and a seller for every transaction. Now, if you're buying something, you think you're an informed buyer, and if you're selling something, you think you're an informed seller.
I know better than you do.
Exactly. Now, there's $212 billion of stocks traded every day, 42 million transactions, where each party thinks they're absolutely smarter than everybody else. So the price that's set isn't based on anybody having any more or any less information. It's an efficient process. Just like the jelly bean analogy, you find out that price is set, by the collective wisdom of all investors.
Of all investors.
So the market's very efficient. You have to trust the price.
And I think that's, we talked about that, we have a tremendous seafood industry here, and we talked about that. It's like if you go into the seafood market one day and the fish is $6 and something, and you go back on Wednesday and it's $7 something, and then you go back on Friday and it's $6.85, you don't say, oh, no, I want to go back to Monday's price.
Right. But we accept that price, don't we?
Yes.
Yeah, and the price does change based on how much the seller can get and how much the buyer is willing to pay.
Yes.
But once that price is set, we accept it. And that's true in jelly beans, that's true in fish, and that's true in stocks and bonds and real estate.
Same thing.
Same thing. So the market price is set by the collective wisdom of all investors at any given time.
And that's such an important thing, and that's where I get very nervous when people come in and they say to me, oh, Annalee, now that you showed me how this works, I can go do this on my own. Well, you really can't, and do it as efficiently.
No, you can't. You can't. And the thing is, there's no advantage to it. Matter of fact, there's a big disadvantage. I used to train other advisors in the industry. It's one of the things that I did as a consultant. And I started every investment seminar with professionals, asking them, why are there unexpected moves in financial markets? And they had every explanation you can imagine. But the reason is they're unexpected, right? So everything that's known is already priced in because people do a lot of work. A lot of professionals study the markets all day long, and they don't have an edge over anybody else because as much as somebody thinks they know, the buy, somebody else thinks they know to sell. So the prices are very efficient. The unexpected moves come because they're unexpected.
Because they're unexpected.
We put together a graph here about orange juice futures, and the price unexpectedly leaped because there were some fungicide fears back in 2012. So, what's unknown, what we call a black swan event, occurs from time to time.
Sure.
But you can't prepare for that. You can't guess that's going to happen. You can't know that's going to happen. But we find so many investors think they can. Think they should know.
They should know.
Yeah, they feel bad.
That they should know. Because they've listened to whomever. And we can do another wonderful analogy in I used to live in New Orleans. You live up in the New Jersey area where the traffic we all know is non-existent, right?
Oh, boy.
And, what happens? You're on this big super highway and you've got 4 to 5 lanes and you get into this lane and all of a sudden what happens?
Well, that lane stops dead. And you sit there and you watch 2 or 3 or 4 lanes of traffic surging ahead and you just wish I was in that fast lane.
Over there.
I want to be in the fast lane.
Yeah.
And what do?
And so you watch your little rear view, and as soon as you see a little space, and you're over in that one.
Yep, and as soon as you get in that lane, what happens?
It stops.
It stops. And the lane you were in takes
It's
off.
moving.
Well, you just explained my whole investment philosophy.
Yeah.
See, I believe that the market is efficiently priced and that the best way to invest is to own the entire market. Now, we do that by owning indexes. All right, so we break the market down into stocks and bonds and real estate and commodities. And we have 12 different investment classes in our model portfolio. Now, each one of those portfolios is volatile. They change in price every day. Some go up, some go down. Now, most investors, when they see our portfolio, what do they want to be? They want to be in the fast lane.
In the fast lane, sure.
And that's what most people do. They load up, they put a lot of money in there, and then as soon as they get all their money in, the fast lane becomes the slow lane. And then they see the lane that they just sold out of take off.
It's moving.
So now they're going to sell out of the fast lane, which is now the slow lane. In other words, they took a loss so they can get into the next hot commodity. And I think that's a big reason why a lot of investors fail. When you look at the investment world, it's not about owning the right bond or the right stock. It's about owning the right mix. And the most important thing you can do is have a portfolio that generates income, both from your dividends and both from your interest on your bonds. But the most important decision you make is where do you reinvest that income if you don't need it to live on.
Right.
Now, a lot of our clients are trying to build their wealth to overcome inflation, so that they have that additional income to supplement our income strategies at Mainstay. And a lot of that money can be reinvested.
Yes.
Now, with 12 different investment classes, what do most of our clients want to do? They want to follow human nature, and they want to get in the fast lane. That's where you and I are so valuable.
Yes.
We say, look, let's not, like last year. Remember last year, Annalee, in your portfolio, big winners were mid-sized companies and our small companies to the tune of 38%. Boy, everybody loved us for those. And then the lane that wasn't moving was our income-generating real estate investment lane, and nobody liked us for those. But we took the income, all the dividends, all the interest, all last year, we kept buying real estate because it wasn't going up. It was the lane we were stuck in. Now, this year, that lane's up 25%. Our small mid-cap stocks, they're the stuck lane. They're not moving.
They're not moving.
That's just a great example of how using common sense and valuation and diversification has helped our clients to achieve their goals.
That's what I was going to say. It's a gorgeous word, diversification.
It truly is.
So if I've got some here and some here and some here, it creates a balancing act. So if this one isn't moving, this one is. And I don't wind up in that position of saying, all of my eggs are in that one basket. I'm not moving. I'm not going anywhere. I'm losing at this point. So
what will happen is the market will take you down to the painful point where you just say, I can't take it anymore, or I'm tired of losing money, and that's when the market lets you sell out, and that becomes an opportunity for our clients.
Yeah, and I think that goes back to what you and I have talked about before, Bob, the importance of having an advisor. You've said yourself to me, Ryan, your son is your financial advisor. Right. You are my financial advisor, so that I don't react or you don't react out of that greed or fear. And that's what we do for our clients. We keep that objective eye that's on everything and watch what's going on and what's happening. Because, like you said, collectively we can make the right decisions.
We do, and that's the thing. That every bit of investment advice I've ever seen given in our industry was based on outsmarting the market, beating the market, getting above market returns.
Yeah.
Well, the fact of the matter is, you don't need to.
No.
Because when you try to beat the market, you're competing with the collective wisdom of all smart investors.
Yeah.
Remember, every buyer, every transaction has a buyer, every transaction has a seller. So why compete with it?
Why compete?
Right? Yeah, embrace it, right? Because the market, all capital markets, have been going up our entire lifetime. And so what we want to do is make sure that we're invested in a strategy that keeps us invested. Now, that's where good advice comes in, because with our strategy, with your planning, which forms the foundation, and when we complement what you do with helping people with their assets that have to overcome inflation, we contact every one of those folks on a monthly and a quarterly basis to help them understand what they own and why they own it, and then demonstrate to them that just because something's doing well doesn't mean that's the best investment. It's like one sunny day doesn't make a summer.
Exactly.
And where to take that excess cash flow that comes in.
Where to go with it. I want you to make me a promise.
All right.
Will you come back and be with me next month? Because we still have so much to talk about.
I mean, we're finished today?
We are.
I'm back next month because I have a lot more to cover.
You are a good man. I appreciate it so much. Call us at Mainstay Financial, 437-3127. Set up a time. Lynette will let you have an appointment. We will start your analysis, look at a plan for you, and we look forward to seeing you next month.